Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better, a CreditSights podcast. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights. And today we will be tackling one of the hottest topics in the market today, the question of whether there are other cockroaches to be revealed in the U.S. capital markets, and perhaps more importantly, who is exposed to this so-called cockroach risk. For those that may have missed it, JP Morgan CEO Jamie Dimon now famously noted, when you see one cockroach, there's probably more, referring to the recent bankruptcy of subprime auto lender Tricolor. Anyways, I have the two perfect guests here with me to discuss this issue. Today, I'll be chatting with Peter Simon, our co-head of U.S. financials at CreditSights and Regional Bank Guru, and Meghan Neenan, Fitch Ratings, head of North America non-bank financial institutions. Peter and Meghan, thank you so much for coming on the podcast today.
Thanks for having me.
Thank you.
Okay, so with the recent failures of Tricolor and First Brands, plus the concerns about Western Alliance and Zions Bank exposures to Cantor Group entities, the recent cockroach debate has emerged as a finger-pointing exercise between the banks and private credit companies. Mark Lipschultz, co-CEO of private credit firm Blue Owl, suggested that banks have greater exposure to these so-called potential cockroaches. So, Peter, I want to start with you. Can you give us a quick update on your view of credit quality within the regional banks' loan books, given we just got through 3Q earnings for a large chunk of your names?
Yeah, so it's really a story that goes counter to the headlines that we were seeing during earnings, which, as you mentioned, centered around, First Brands, Tricolor, the Western Alliance, Zions situations. But if you look at the numbers that the regional banks were reporting this quarter, they all looked really solid from a credit quality standpoint. Actually, I would say trends were stable to improving. If you look at the non-performing loans and net charge-offs that the banks were reporting, I'd say most banks were relatively flat or slight improvement from last quarter. If you look out a little bit further from a year ago or from a couple of years ago, trends still look like they're an improving trend. So you would not look at the numbers ex headlines and say that we see any evidence of a turn in credit. Even among the small number of banks that were impacted by situations this quarter, guidance overall remains stable at those companies. And you might have a 1 quarter blip in net charge-offs or in a move to non-performing, but there's all indications right now that those are kind of lumpy one-offs, which you do tend to see in commercial credit. It's not unusual. I think what was unusual this quarter was just the kind of the fraud angle that seemed to be the common thread among some of these situations. But no, certainly, from everything we see right now, obviously that can change based on the macro environment, but credit quality looks quite solid across the regional banks right now.
Okay, so the regional banks look good. And Meghan, I know you have been covering BDCs as part of your non-bank financial institution coverage broadly. The publicly traded BDCs have taken a hit following the two recent high-profile bankruptcies. Are you concerned about the credit quality within these BDC portfolios? Did the BDCs even have material exposure to these most recent high-profile bankruptcies?
Yeah, sure. I mean, just taking a high level view, as you mentioned, we rate 32 BDCs publicly. So we have a good perspective in terms of credit performance. And I would say, generally speaking, we feel pretty good about BDC credit performance um, in terms of, losses in particular. But I think the theme of the day, or really for the last 18 months, has just been increased differentiation in terms of performance. So if we look at net realized gains and losses over the first half of the year, on average, those 32 BDCs have recorded losses of about 60 basis points. But that ranges from net gains of 1.7% to net losses of 6.4%. So really a lot of differentiation there. In terms of portfolio profiles, we get a lot of information on underlying portfolio companies. And I think we've seen leverage tick up a little bit, certainly over the last couple of years, but EBITDA growth continues to be solid. We're talking about average loan to values really in the 45 to 50% range. So there's still a lot of equity kind of underneath where these BDCs are lending. Pretty good performance and feeling pretty good as rates come down with improving debt service as well. I think just to touch on another key theme, though, is PIK, or paid in kind income. That's been a big headline issue. So we've certainly seen that tick up. So for the 32 PDCs we rate, average PIK as a percentage of interest and dividend income is about 8% of the portfolio, or 8% of that income in the first half of the year. And that's double from where we were pre-COVID. But we really need to break that down into what a lot of people are calling good PIK and bad PIK. So some of that PIK is amendment related, and some of it is just structured at origination. And so there's not a lot of disclosure around that. I would say it's pretty selective, but we get some good information from the BDCs on a private basis. And I think structuring has been a competitive tool for them to kind of attract more deals from the broadly syndicated loans, especially with the lower or below normal kind of M&A environment. So we've seen more of those. And I think as we see M&A pick up, and if this M&A recovery has some legs, I think we'll see some PIK repayments next year. Although I do think structured PIK is probably here to stay. Once a term kind of comes into the market, it's harder to kind of get rid of it. But to your point too, just on the bankruptcies and the exposure to those entities in particular, it's really modest. So for First Brands, there's two BDCs within our rated universe that had some exposure. One was Goldman Sachs in their perpetual vehicle. It's not unusual for the perpetuals in particular to have a broadly syndicated loan sleeve, because those perpetuals have redemptions that they have to fund. So still, that was a very minor exposure for them. And then we had Franklin BSP as well, who had exposure in their joint venture. And again, that joint venture has a little bit of a different strategy, so not unusual that they would have some BSL exposure there too. But overall, I think there were maybe 15 BDCs in total that had exposure to First Brand. Didn't see Tricolor pop up anywhere. And overall, very, very modest, exposure across the board.
Okay, a lot of great information there, Megan. So just to flush that out a little bit, all of the BDC exposure to First Brands was to a BSL, so not a loan originated within the broader private credit space, correct?
That's correct. Yep. It's definitely a broadly syndicated loan deal, not anything that was private credit backed or originated.
And in terms of that credit performance, I think you mentioned, on average, a loss of about 60 basis points, maybe more differentiation. And would you say that's kind of growing differentiation in terms of that credit performance? How do you think about, to me, when I think, maybe growing differentiation, that could be an early sign of not necessarily stress, but kind of maybe flushing out who has had better underwriting standards or been better credit pickers? Are you thinking about it from that perspective as an early sign of more challenges to come from those that are sort of at the lower end of that spectrum? Could you just touch on that a bit?
Yeah, I mean, I think in 2024, just to give some relative numbers, average losses were 1%. And that was a range of 1% gains to 4.9% losses. So the range has widened versus just 2024 in total. But I think because it's a range and it's such a big range, I think it really points to idiosyncratic issues in portfolios and more about credit selection. So we don't think there's a canary in the coal mine. And even from a sector perspective, there's nothing that's super thematic. We took a few negative rating actions this year. We downgraded one BDC to sub-investment grade, and two, we put on negative outlook. And while asset quality was a theme across all of those, I would say that the issues were different. So one BDC that we downgraded, BlackRock TCP, they had outsized exposure to the Amazon aggregators. So that was about half of their portfolio or half of their non-accruals, excuse me, at the end of 2024. And others certainly have exposure to some of those names, but not to the same extent. So I would say there's pockets of issues. We've also looked closely at portfolios following Liberation Day to try to get a sense for kind of what tariff exposure was. And, if you just look at categorizations around like capital intensive manufacturing, auto type exposures, it's less than 10% of BDC portfolios. So it's pretty low. They tend to focus on not capital intensive businesses, less cyclical businesses. And so I think they would size their exposure really to kind of mid-single digits. And since then, there's certainly been some actions taken to counteract any kind of impact from the tariffs. And then I think from a sector perspective, people are also very focused on AI because software is such a big part of BDC portfolios. So software, healthcare services, and business services are the top three sectors. So all very services oriented in terms of BDC exposures. But I think AI, it's early days. I think some of those businesses will benefit. Some might be a bit more challenged. It's certainly something that they're more focused on from an origination perspective. But I think it's something they're very mindful of. So nothing super thematic. I think it really feels very idiosyncratic at the moment.
Okay, great. That's certainly our sense. And I think the narrative out there is kind of a growing bifurcation and concern of this happening within the auto sector and a couple of these things sort of occurring at once. People becoming concerned that it's more symptomatic than idiosyncratic. And it's good to hear from your perspective. It looks to be an idiosyncratic issue. Peter, going back to you, people are saying regional banks are back in the headlines with concerns about their exposure to these recent bankruptcies that were driven or at least hidden for a time by fraud. And people are kind of lumping this in with the idea of regional banks being in the headlines in 2023, but that was more of perhaps an asset liability mismanagement, particularly from Silicon Valley Bank. And so I think it'd be helpful for our listeners to sort of frame up how different the issue is this time and maybe your perspective on if there are any concerns on the interest rate risk management or asset liability management side within the regional banks, or has that all been cleared up? Was there even anything to be cleared up symptomatically throughout the regional banks, or was it more of a few, let's say, bad actors that came to light in 2023?
Yeah, no, I certainly think that a couple of years ago, interest rate risk was really front and center for the banking sector, whereas like I said, I don't see credit turning as of yet, but I think certainly I think there's much more of a valid concern on the credit side than the interest rate risk side. From one standpoint, the environment has gotten a lot easier from an asset liability management standpoint, but because rates have just become much more stable compared to 2022, 23. So I guess it's difficult to say how much better position the banks are from that standpoint because it's just an easier environment to manage through. But having said that, you are seeing what you would expect to see in this environment, which is steady deposit growth, stabilizing net interest income, net interest margin, and improvement in those securities portfolios, which had some, or in some cases severe unrealized losses. Those are steadily improving. There's still some losses remaining, but much better position. And overall, and this kind of circles back to the credit discussion, is the capital of the regional banks is much better than it was 3 years ago. If you look, the average tangible common equity ratio for the regionals that we cover was around 5%, which for those who aren't, who don't watch these banks as closely as I do, that's low. It's in a much better position. For this most recent quarter was 7.5%. So over 200 basis point improvement on average. So that speaks to loss absorbency, right? Sort of bank analysis 101 is banks do not expect to never have losses on their loan portfolios, right? They are pricing the risk to have to be able to absorb some losses and have the capital and reserves to absorb even not just individual losses, but some changes in the credit cycle as well. So, as we sit here right now, like I said, I don't see signs that the credit cycle is turning, or you don't see that in the bank's portfolios. But I do think the sector is in a good position, in terms of those balance sheets. If credit were to turn, I think it would be absorbable, for these large diversified regional banks, and certainly the larger banks. Should be able to withstand, some uptick in losses.
Great. I think that's really important to point out. And at least from our strategy perspective, we are expecting the Fed to continue cutting rates in 2026. And so in terms of the overall interest rate environment, whether that be for fixed rate assets in banks' investment portfolios or in terms of their loan portfolios, looking for kind of an improving backdrop there. And I know that's important, Megan, in terms of the loans that are typically made to kind of the companies that borrow in the broader private credit space, including from the BDCs. And so it seems to me, from both of your perspectives, credit quality within both regional bank and BDC portfolios look solid and may even be improving. In certain instances, Megan, you alluded to leverage ticking up a little bit, and I guess I would put that maybe not in the loss column, but in the ties. Certainly rising leverage, depending on what's driving it, can be concerning, especially depending on where we are in the economic or business cycle, which I think there's a lot of debate around that right now. We're a little more concerned that we could be later on in the cycle where increasing leverage could be kind of concerning in terms of if economic fundamentals were to turn. But overall, it seems like you're not expecting a ton of cockroaches to come crawling out of the fridge beneath the fridge in the regional bank space or the BDC space for now. But what are you concerned about? What are some of the things that you're seeing? Megan, I want to start with you. I know that when we discussed this podcast, you kind of mentioned a maturity wall in 2026. Are you concerned about some of the different structures popping up in the BDC space? Take us through what might be worrying you in the market today.
Sure. Maybe I'll touch on BDCs and then private credit a little bit more broadly as well. So I think competition has been intense in direct lending and private credit, but with M&A being below average, that has resulted in some really competitive conditions, which have tightened spreads considerably. And we think that spreads have kind of reached a bottom. And so the question is, if this M&A rebound has legs, that's certainly good from terms and conditions and an underwriting perspective. If it doesn't and it remains really slow, I think the question is always, what's the next to go? Because you continue to have funds kind of flowing into direct lending vehicles and perpetual BDCs in particular. So there's still a lot of capital chasing, maybe not enough deals. And so I think you start to then focus on, just terms, leverage, and covenants and those things as well. So I think we'll definitely be keeping an eye on that. You mentioned floating rate assets with rates coming down. That's certainly good from a credit perspective in terms of debt service. But because BDCs are floating rate, we do expect net investment income to come down. I would say several years ago, we were saying there were excess earnings in the sector. So I don't want to say this was unexpected. This is kind of the expectation. But then we want to see BDCs act prudently with regard to dividend management. So certainly their coverage of their dividends is coming down, and we have seen some dividend cuts in the space. Some have set up kind of variable dividend structures with a low base and a supplemental. And so I think those are working as rates start to come down. But because they have to distribute 90% of their earnings on an annual basis, we want to make sure they're being prudent with regard to that. And then the other thing you mentioned is just the maturity wall that's coming. And so coming out of the pandemic in 20 and 21, we saw a lot of unsecured issuance from the BDCs. You saw perpetual BDCs really getting forward, BCRED in particular in 2021. So there's a lot of debt that's coming due next year. It's $12.7 billion for the 32 BDCs that we rate. So pretty significant. This year has been a good capital markets environment. So we've seen a lot of issuance. So we think that 2026 maturities, about 50% of them or so have been pre-funded. So that's a great start to kind of moving that down. You mentioned to start this off, there's been some dislocation in bond spreads recently, just with some of the cockroach noise that's out there. And so we'll see how quickly that kind of rights itself, and if we see some more issuance, um, towards the end of the year and certainly into next year. But we do expect them to remain active and in the unsecured capital markets. And if they don't, they certainly have secured revolving capacity that they could use to refinance some of their upcoming maturities. But then at certain points, we start to worry about funding flexibility. We have some investment grade kind of thresholds that we look for, and there's probably 9 BDCs if they just kind of refinanced with their secured revolvers, they could kind of dip below our expectations. So that's something we're certainly keeping an eye on. And then the other thing just on private credit more generally, just thematically to touch on, is certainly the insurance companies and the tie-ins with the alt managers. So we're seeing, there's a lot more focus on that. So we have, the big three in particular, Apollo, KKR, and Brookfield, who own insurance companies outright. A lot of investment grade paper being created for those insurance companies. From an asset management perspective, you have captive capital there that's generating some good fees and helps you to seed new strategies. But also there's more interconnectedness between that and potentially some more risks to be thinking about in some of those life insurance companies. And our life insurance folks put out a report not too long ago just saying level 3 investments or more liquid investments are about 26% of life insurance portfolios if they're affiliated with an alt manager. And that's, 4 to 5 times what it is for the unaffiliated alt life insurance company. So definitely a difference there. And then the other thing is the retailization or democratization of credit, however you want to talk about it, or of private assets. But, the perpetual BDCs is something certainly really, it started in the real estate universe with Blackstone REIT, BREIT. Then Blackstone launched BCRED in 2021, and now you see a lot of perpetual BDCs are out there, but you also see that wrapper being replicated for secondaries, private equity, infrastructure investments. So lots of things being fit in those structures. And I think the concern there is really about liquidity risk, because you do have redemption terms in those vehicles, and also just suitability. So do retail investors kind of understand what they're investing in? So I think it's important that people understand, is there a liquidity sleeve that's in these different vehicles? Is it adequate to help fund those 5% or 3% caps, just depending on the structure and the kind of collateral you have in those vehicles. But we expect those are going to continue to grow. And now that you might be able to put private assets in 401ks eventually, that trend's just going to continue. So we're certainly keeping an eye on all of those things too.
Yeah, I feel like a couple of years ago when I first started looking at the private credit market, my initial take was perhaps the real risk is interconnectedness, which seems like, if anything, has probably only intensified to some extent. But of course, I think both the private equity and private credit arms of these larger asset managers tend to have a fair amount of dry powder. And we don't have to get into how much of that could actually be used to support any issues within, portfolio companies or kind of across the broad universe that they invest in. But there is at least some, I'd say, mitigating factors there. And then I think the liquidity risk and the suitability, that seems to be the new issue that's top of mind. Peter, one of the things that Meghan mentioned that I feel like came up in one of our recent discussions is the possibility of too much cash chasing too few assets, or too much demand for credit or willingness to lend. Are you seeing that in the regional bank space? Are underwriting standards taking a hit from your perspective? And is that something to worry about? Or are you kind of comfortable with that environment? And if so, what else are you concerned about in the market today?
Yeah, I mean, we're not really seeing evidence of it. I mean, I think it's always difficult to say until after the fact, and certainly no management teams comes out and says we're loosening our underwriting standards. But yeah, we're not really seeing evidence. I mean, credit deterioration usually follows, some period of rapid growth, at least in certain categories. And we're not really, we haven't really seen the banks have not really been aggressively expanding lending in the last few years. I mean, they certainly did for a period coming out of COVID. And, we saw some deterioration in pockets of the bank's portfolios in, say, 2023, 24, particularly consumer and CRE, which was really more of an idiosyncratic issue with office. But in, more recent vintages, kind of, 2023, 24 into this year, loan growth is picking up a little bit, but we don't really see the, regulated bank space aggressively expanding lending. That may be in contrast to some parts of the non-bank financial world. I think it's something that investors are certainly starting to focus on more. If there is one area within commercial lending at the banks that has grown in recent years, is the exposure to non-bank financials. So that's certainly something that we're getting a lot of questions about from clients. It's something we've been watching, and there's been more disclosure this year in the regulatory financials, but I think the market is starting to pay attention to more because of some of these issues, not all of which necessarily related to private credit per se, but from the way we see it, I mean, that is an area that has grown more rapidly than other parts of the portfolios in recent years. So it is, from that standpoint, it's worth paying attention to. We don't see evidence right now that there is any meaningful deterioration within those portfolios. And I would say that, it's a broad category. So if you break it down, not all of it is private credit. Some of it's private credit, some of it's consumer lenders, some of it's private equity. There's no, if you look at individual banks, the exposures don't really look large enough to really be super concerned about from a concentration risk standpoint. So, it's something we're paying attention to, but not really seeing anything too concerning right now.
I think that's a great point, Peter, and something that Meghan and I have discussed a little bit. And so just to be clear for our audience, Peter is talking about the regulated banks lending to non-bank financial institutions such as a BDC that then lends to end borrowers that might be, let's say, have higher leverage. They don't have to provide the same type of financial disclosure that publicly rated companies do. And so you kind of have this question of leverage on top of leverage. And so, Meghan, I wanted to give you an opportunity from your perspective in your seat. Are you seeing a big increase in borrowing or use of leverage within the BDC or other non-bank financial institution space along the lines of what Peter is mentioning? And I don't think, necessarily having growth in that area means you have to see too much leverage or a big increase in leverage for even individual names or pockets of the space, but would love to hear kind of what you're seeing from your perspective.
Yeah, I would say on average, the BDCs are under levered right now relative to their targets. I would say, we've been rating BDCs since 2005. The leverage limit used to be 1x debt to equity. And then in 2018, with the passage of the SPCAA, that doubled. And so we did take a close look and say, how does that change the way that we think about these? And most BDCs, their levered target is now up to 1.25. And pre-SBCAA, sometimes BDCs were levering, up to 0.8, 0.9. And so the cushion has really increased relative to not just the requirement under the Investment Company Act of 1940, but that covenant or requirement is also generally in bank revolving agreements as well. And so the cushion there has increased pretty significantly. And I would say, the market for unsecured investors has deepened considerably over the years, particularly, the last 5 years, I would say. We've seen some BDCs actually issue unsecured debt into Europe, the UK, and even Australia last year. And so they are working to kind of continue to deepen that market because, look, some of these platforms have gotten really big and the banks might have some concentration limits. Banks generally are lending to the space with syndicated revolvers or SPV facilities. But if you have a BDC with, multiple BDCs on a platform, that can be a bit challenging. And so I think you're seeing some of these BDCs look to access other markets as well. CLOs are starting to pick up, I think, in terms of activity. And so I think we're going to continue to see them look to round that out and diversify their funding sources. But generally speaking, I think leverage is probably poised to tick up a little bit, especially if we see some rebound in the M&A market, because most BDCs are a bit underlevered relative to their targets right now.
I think that's a great point. I feel like a recurring theme throughout this discussion has been cushion, whether it be kind of increased capital at the regional banks or some cushion or ability for BDCs to increase their leverage without really coming close to their leverage targets, and certainly not tripping the limit of 2 times. I think, it's worth highlighting kind of this self-imposed management of the leverage to around 1.25, despite from a regulatory perspective having room to go all the way up to 2 times. And so I think that's really interesting and important to point out, and really separates the true analysis and understanding the fundamentals versus kind of what you see in the financial press, which can really conflate various topics and take a few big headline names, which it's interesting that we have had a couple of these things all at once and apply them as a blanket to credit concerns. And that's probably seemingly unjustified, or at least if there is going to be more in terms of losses, there seems to be plenty of cushion or capacity to absorb some of those. And I think, Peter, your point about that being the regular part or a regular aspect of lending, you're not expecting every single company to repay everything throughout an entire expansion or business cycle, or however you want to think about it, is really important. All right. I think we covered a lot here. I really appreciate you both coming on the podcast. For now, it seems like cockroaches are not going to come scattering throughout the capital markets, but it's something that we'll certainly be watching, and we'll be looking to update our listeners as we go through. So Peter and Meghan, thank you so much for coming on No More Risk Better.
Thank you, Zach.
Thank you.
And thank you all for tuning in. We'll catch you next time. Good luck out there.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.